Well, thanks, Kelly. Yes, and thanks so much for joining us. Your first time on CNBC since taking the helm last year. Congratulations.
Thank you.
You heard some of the stats. We know that apartment construction was just completely overbuilt in the last 2 years, and yet we're seeing occupancy holding steady at 94%. Give us the fundamentals that you're seeing in the market right now for apartments.
Oh, sure. I'm so glad to be here, and thank you for having me. It's an interesting dynamic because you would think that with supply where it is right now, the multifamily fundamentals is very strong. And it's really for two primary reasons. Even though there has been building, there is still an acute housing shortage. And in certain markets, the supply has ramped up. But for the most part, especially in the West Coast where we are, where the supply is about 0.5% of total stock. So that's very low. We actually need to build a lot more than what we have. But the second key component is affordability. It is much cheaper to rent than to own. And so consumers are still choosing the more affordable option.
And that's, of course, because we have interests on mortgages at, near record high, well, not record highs, but near the cyclical highs at about 7.5%, driving people to rent. If we do see the Fed start to lower rates and mortgage rates start to come down and more people get into home ownership, do you think that's going to hit the rents?
I do think that in certain pockets where there's already significant supply, it'll be more vulnerable to mortgage pricing. But for example, in the West Coast, because there's such shortage of housing supply, and on the flip side, what we're seeing is a strong demand. And what is happening with our markets and in certain parts of the U.S. is that you have growing industries. So, for example, artificial intelligence, they're hiring a lot more people. Now, 85% of those companies are in the West Coast. But that job growth is the key driver for new household formation, which will drive demand for new housing. So what we're building right now is barely keeping up with the demand that's necessary.
That is fascinating.
And Kelly has a question for you.
Diana, thank you. But Angela, I just heard you say that Essex is an AI play because all the employees being hired are living potentially in your area of the country. So that's super interesting. My question was just going to build on what Diana just said. Are you cheering for interest rates to go up or to come down?
Boy, that's a really tough question. What we have expected was that the Fed has announced that they were going to lower interest rates at some point, and they kept pushing it back because it's not a bad reason, because the market is strong, the economy is strong. And so for those reasons, it would be tough to see an interest rate decrease at this point, especially with the continued inflationary pressure. But at some point, you would think that relief valve has to occur.
And what about the cost of capital, especially when you want to get into new development? You're not necessarily going to the big banks and lenders, but to private capital, private equity. Is there money on the sidelines looking still to get into more apartment?
Well, there's a large amount of capital interested in apartments. However, the focus is really more completed projects. And so what we're seeing is that whenever, transaction volume across the U.S. has been quite low, historical low. So whenever an apartment comes available for sale, especially in our markets, there's a significant number of buyers, all the way ranging from both domestic and international large institutional owners. And so for those reasons, we're just going to see the dynamic to continue.
And there's a lot of talk here at the REIT conference. In fact, we were just talking to the CEO of BXP about office conversions to apartments. And we're seeing more of that in places like New York City, some on the West Coast. Do you think that's going to add too much supply if we start seeing all of these distressed office buildings becoming apartments? Obviously, not everyone can, but they're starting to pencil differently and get more creative in changing that supply.
That's a great question. What we're seeing is that in certain cases, specialized cases, that could work, but it's so hard to make pencil because the office plate, the physical, building makes it prohibitive because where the elevators are, you need to have a certain distance to the wall. And so large office buildings, by nature, you just can't even convert them. And it's really expensive. So you've seen one or two in the West Coast, but certainly not at the volume that people have anticipated. So we just don't expect that to occur.
Now, we're seeing big jumps. In fact, a 20% jump in single family built for rent only. That is, companies like American Homes for Rent, Invitation Homes, and others building entire single family rental communities. Does that eat into the demand for apartments when people might be able to rent a single family home at the same price?
Yeah. I do think that there will be that competitive supply pressure in certain markets. And in fact, supply is probably the leading cause of rental pricing disruption. But in our markets, it's so difficult to just even get a large tract of land. And so in the West Coast and where we operate, downtown Seattle, suburban Seattle, in those markets, it's virtually impossible to put up large amount of supply.
Angela Kleiman, CEO of Essex, thank you so much for joining us. It's been a pleasure.